All right, let's talk Shopify. They're one of the biggest names in e-commerce, right? But their latest earnings report, well, it sent some really mixed signals. So today, we're going to cut through all that noise. We're going to dive in and decode the numbers, and we're going to use Shopify's own official filings as our guide.
So here it is. This is the big puzzle we're here to solve. On one hand, you've got this amazing top-line growth. I mean, revenue shot up 27% year over year. That is huge. But then you look at the bottom line and whoa, a net loss of over $500 million. So what is the real story here? Are they growing or are they losing money? Well, the answer is kinda both. And we're about to see exactly why.
Okay, so to really get what's happening with Shopify, you first have to understand where their money is actually coming from. You can think of the company as being powered by two different but totally connected engines. Let's break them down.
So Shopify's revenue basically comes from two main buckets. First, you've got subscription solutions. That's the classic monthly fee merchants pay to use the platform. That grew by a very healthy 21%. But, the real story here is merchant solutions. This is all the other stuff, payment processing, getting loans, shipping, and it's not just the bigger piece of the pie, it's growing even faster at nearly 29%. This is the engine that is absolutely on fire right now.
But, and this is super important, there's a trade-off. As Shopify processes more and more payments and offers more of these services through merchant solutions, its overall profitability for each dollar actually goes down. Why? Well, because there are third-party costs baked in, like credit card processing fees, that you just don't have with pure software subscriptions. So, as the revenue mix shifts toward this faster-growing engine, it puts a squeeze on their overall gross margin. It's more volume, but the margins are definitely thinner.
Okay, so the revenue growth makes sense now. Let's tackle the other side of this paradox, that big headline-grabbing loss. I mean, where did almost $700 million just vanish? Let's play detective and solve this thing.
And here's that number again, the official figure from their income statement, a net loss of $682 million. Now, for a lot of people, the analysis stops right here. But honestly, that would be a huge mistake because the real story is buried just one layer deeper.
And boom, here it is. This is the smoking gun, pulled directly from their financial statements. In just Q1, Shopify reported a paper loss of over $1 billion on its equity investments. Look at that. That single number is bigger than the company's entire net loss. In other words, if you just set aside this non-cash investment loss, Shopify was actually profitable from its operations.
So what in the world is this billion-dollar item? It's something called an unrealized loss. Okay, think of it like this. If you own a stock and its price goes down, you have a loss on paper, right? But you haven't actually lost any real cash until you hit the sell button. That's exactly what happened here. Shopify holds investments in other companies, and their value on paper just happened to go down during the quarter. Accounting rules say they have to report that as a loss, even though no actual cash left their bank account. It's a paper loss.
And just to be super clear, this isn't our opinion or some hot take. This analysis comes directly from the source, Shopify's official 10-Q filing with the SEC. All we're doing here is connecting the dots that are already laid out for everyone to see. So, if that big net loss number is all twisted up by these paper investment losses, what should we be looking at? Well, let's pivot and look at the numbers that Shopify's own management team points to as the true signs of the business's health.
First up is gross merchandise volume, or GMV. This is the total dollar value of absolutely everything sold by merchants on the Shopify platform. And get this, in just the first 3 months of the year, that number was almost $75 billion. That's up 23% from the year before. It just shows the staggering scale of commerce that is flowing through their ecosystem. The second key metric is monthly recurring revenue, or MRR. This is that stable, predictable income from their core subscription plans. At the end of Q1, it hit $182 million, which is a really healthy 21% jump from last year. This shows us that the foundation of the business, the subscriptions, is strong and growing at a great clip.
And just so you can see for yourself, here are the definitions, word for word from their report. GMV tracks all the activity on the platform, which is what fuels their merchant solutions revenue. And MRR, well, that tracks the health of their core subscription business. When you see both of these growing at over 20%, it paints a very, very different picture of the company's health than that scary headline net loss figure, doesn't it?
So, we've established the core business is actually quite healthy. Now for the final piece of the puzzle. Where is Shopify putting its money to make sure it keeps growing, not just next year, but for years and years to come?
Right in their filings, management lays out a super clear roadmap.
They're betting big on AI, they're pushing hard to win over bigger enterprise clients, they're expanding their global footprint, and they're continuing to build out that awesome ecosystem of app developers and partners. This is basically their blueprint for the future.
And look, these aren't just empty words. They're really putting their money where their mouth is. For example, just in this first quarter, they went out and bought a company called Vantage. Now, this wasn't some massive, earth-shattering deal, but it was really strategic. It's all about bringing advanced AI search tech right into the Shopify platform. It's a crystal clear signal of how serious they are about that AI pillar.
You know, this quote from their management discussion really just sums it all up perfectly. They see themselves as building a 100-year company. They're focused on balancing that long-term growth with profitability, and they're not scared to make investments in tech, in acquisitions, in the market that might not pay off right away, but are designed to secure their future for the long haul.
So that brings us to our final thought here. When you actually look past the confusing headlines, what you see is a company with a really healthy, growing core business. A company that is deliberately using its resources to make big, long-term bets on the future of commerce. Essentially, it's trading clean, short-term accounting profits for what it hopes will be decades of sustained growth. And the big question that leaves us with is it the right move?